Chicago businesses should be paying attention to the upcoming Fed meeting in May. A couple things are going to come out of that. The Fed has clearly been signaling that they are going to increase rates by a full 0.5%, which is an unusual move. We haven't seen that kind of rate hike in a long, long time. But the Fed is also going to start setting expectations for future rate hikes. Will this be the new norm? How far do they see rate hikes going? Critically, they're also going to start talking about their what's called quantitative tightening, selling some of those securities and other assets that they've built up into their balance sheet. All of that could mean changes in interest rates that impact Chicago businesses, their cost of borrowing, or industries that are interest rate sensitive, such as housing, are all going to be impacted by some of this. Our view at Fifth Third is that the Fed is very intent to get back to neutral, and are going to be very aggressive to get back to what's considered a neutral interest rate. No one really knows where that is, probably somewhere in the vicinity of 2.5% Fed funds rates. That implies quite a few more rate hikes. At that point, though, we think the Fed is going to be a little bit more circumspect. They want to get to neutral, but they don't want to risk a recession critically, particularly because we have over 6 million job seekers. It's very unusual in a Fed tightening cycle to have that many people looking for work. They will find jobs, or most of them will, because we have roughly 11 million job openings, but that's going to take time. The Fed wants to make sure that they don't cut off job opportunities when you have so many people who are still looking for work. The Fed, though, is very eager to contain inflation expectations. They know they got this wrong. If the classical formulation for inflation is too many dollars chasing too few goods, the Fed focused very heavily initially on this concept of too many dollars. Where did those dollars come from? It wasn't actually so much from the Fed. It was fiscal policies related to the pandemic. So stimulus payments, stimulus checks, pandemic checks. It was augmented unemployment benefits. And it was also an inability of consumers to spend during the most lockdown periods of the economy. So that's creating a surge of demand for goods. And the Fed quite appropriately looked at this and said, well, this won't last forever. To use the Fed's terminology, transitory. What they missed is that there's the other side of the equation. It's not just too many dollars, it's too few goods. And so we've seen big disruptions in the supply chain that have been inflationary. We've seen a labor shortage that is driving inflation on its own and is also exacerbating these supply chain shortages. The Fed needs time for those to resolve themselves, but can't let inflation expectations get out of control. One thing we would urge Chicago businesses to do is to be very careful about being too pessimistic. It's become common to identify Fed tightening patterns with upcoming recessions. That's not always the case. The Fed is certainly trying to manage what's often called a soft landing, where they maintain inflation through taking some of the heat out of the economy, but not stopping it. The Fed can actually do that. They did that, say, in the mid-1990s. And we think it's actually more likely to engineer a successful soft landing because of labor market characteristics. So don't get too pessimistic. Yes, you always want to be prepared for the risk of a recession, but that's not our base case. That shouldn't be the base case for employers.